Hello to everyone who strives for growth. After all, if you're watching us, it means you boldly explore the latest trends in this world, are constantly searching, and combine different ways to create your own comfortable lifestyle and path in this challenging world. Today, we already have the third episode on the topic of farming, and we're happy to continue analyzing this fascinating subject. In the previous episodes, we took a detailed look at liquidity pools in general and on Stone, FI in particular, including pairs such as Keton, TON, and USD, and also discussed the main risks and strategies of farming. Today, our focus is on new promising pools, especially the high-yield Switch TON pool with an impressive APR of 671% per year, and the meme token pool, Baby Doge Bake TON, with a yield of 656%. We'll dive into the details of these new offerings, examine their features, risks, and potential, and also explain how these pools can impact your farming strategy. Stay with us to learn more. Let's get started. First, let's look at the high-yield pool with the PocketFi Swift TON token. Its yield is an astronomical 671% APR. Description and purpose of the tokens. Switch is the native token of the PocketFi 2 platform. PocketFi is a cross-chain bridge focused on connecting TON and Solana directly within Telegram. The project offers Hyperfabric deep-in functionality, essentially a convenient bridge between TON and Solana, integrated into TON Connect, so that Telegram users can easily and quickly swap assets between TON and Solana. The Switch token plays a key role in this ecosystem. It is likely used for paying fees, staking for bridge usage, or as a governance token. The appearance of Switch on Stone, FI is a strategic integration aimed at expanding DeFi capabilities for the TON community, providing access to Solana assets through PocketFi. Simply put, TON users can now swap TON for Solana assets, such as SOL or USDC on Solana, without leaving Telegram. And the Switch token reflects the value of this service and participates in the bridge's economy. The Switch TON pool provides liquidity for trading the Switch token itself on TON. Its presence is critical. Switch holders need a way to convert it into TON. And conversely, TON investors can buy Switch if they believe in PocketFi's success. Stone, Them, launched the pool as WCPI, likely with a nonlinear invariant, although the details have not been disclosed. It might be a standard 50-50 pool. Importantly, the launch of the pool was accompanied by a farming program, since the main attraction is a very high APR. It was reported that the annual percentage rate on this pool exceeded 600% at the end of May, and at the beginning of June, the APR reached 670%. There were even brief moments when it hit 787% or 999% as the price fluctuated. It's just out of this world. These numbers are explained by the distribution of rewards. In summary, Switch TON is a high-yield but high-risk pool associated with a new cross-chain project. It attracts farmers with huge returns, while providing the project with the necessary liquidity and drawing the attention of the TON community. The source of the project's yield. Such a high APR is due to farming rewards. In this case, according to official data, farming was launched with a price pool of 10,000 TON tokens until a certain date. In other words, StoneFi incentivized the pool by distributing its own TON token to Switch TON LP stakers. Additionally, it's possible that the Switch token itself was also distributed, but the available information specifically mentions the 10,000 TON. At the time of launch, 10,000 TON were valued at approximately $21,000. This distribution started at the end of May and will continue until June 19, 2025, and is accompanied by a lockup requirement, meaning LP tokens must be locked for 30 days. In other words, farmers who entered the pool committed to keeping their liquidity until the end of the program, otherwise they would not receive rewards. This measure prevents instant capital shifts and promotes liquidity stability. An APR of 671% means that over a year you would receive the equivalent of 6.7 times your initial deposit. But since the campaign lasts less than a month, the actual ROI was about 55 to 60% for the period. This of course assumes that token prices remain unchanged. In practice, prices fluctuated significantly. Additional yield factors. In addition to the Stone airdrop, the liquidity provider also earned fees from trading Switch Ton. This token is highly volatile. The price first rose, then dropped sharply. Trading volumes were significant during the hype. The commission APR could add dozens or even hundreds of % in the first days due to the wild volatility. However, as the price stabilized, the commissions decreased. Finally, there may have been a bonus from PocketFi. Sometimes, projects allocate their own tokens for farming as well. It is unclear whether this was the case with Switch. Some sources mentioned bonus tokens for liquidity providers in the pools. For example, APR provided bonuses. PocketFi could have distributed some Switch for liquidity mining, but there is no confirmation of this in the official announcements. If it did happen, it is included in the APR figure. StoneFi calculates the total APR, which includes all rewards. In summary, the main source of income was a one-time campaign with TON tokens. That is what generated more than 600% APR. After it ends on June 19, the APR will rapidly drop to a level supported only by trading fees and any possible ongoing distributions from the project if they decide to extend the campaign. The commission-based APR without incentives will most likely be quite low after the wave of hype. Technical risks. Switch token is a new and little-known asset. Technically, it is a token on TON, following the token standard. Its contract may carry standard risks, minting, admin keys, and similar issues. We hope that the token has a fixed or controlled supply. If the PocketFi team holds the majority of the supply, meaning that most of all Switch tokens that can be issued are controlled by the PocketFi project team itself, rather than by regular users or investors. Then, if they decide to sell a large number of tokens, this could lead to a drop in their price, since a large quantity of these tokens would enter the market. This is called dump risk, a sharp price drop due to a large supply. Technically, they can pour their tokens into the pool and sell them, crashing the price. This is more of a market risk, but it stems from the specifics of the contracts. PocketFi smart contracts. The bridge infrastructure itself is a complex system, but it is only indirectly related to our pool. If the bridge is hacked or operates unstably, it may affect the value of Switch, but not directly the operation of the pool on StoneFi. Audit. It is unknown whether PocketFi has been audited. Since they interact with Solana and TON, security risks are high, but for liquidity providers, the main contract is the pool with StoneFi, which has already stood the test of time. Stone, FIV2 operates reliably, and any errors would affect the entire exchange, not just this particular pool. Liquidity concentration. The high APR has likely attracted a limited group of farmers, meaning those who are not afraid of risk. If liquidity is concentrated among a few large players, whale dominance is possible. In the event of any disruptions, they will be the first to withdraw liquidity after the lockup ends, which could cause price swings. Technically, this is not a bug, but it does affect the dynamics. Probability of exploits. There was a small chance that someone might try to attack the farmers, for example, by suddenly crashing the price of Switch a direct manipulation. However, the lockup prevented an immediate exodus, making it difficult to cause significant damage. Farmers are still locked in, and traders bear their own risk. Reliability of the PocketFi project. If the founders turn out to be dishonest, unexpected events may occur. For example, issuing additional Switch tokens without notice or changing the bridge rules. This is already platform risk. Overall, from a technical standpoint, the Switch TON pool carries the standard risks of new tokens, such as the potential for failures in the token itself or in derivative products. But the farming mechanism itself is implemented in a standard way, and, according to information available at the time of completion, there were no incidents. Market risks. Volatility. Switch turned out to be extremely volatile. According to Binance Square, after its debut, the token rose by about 13.5% in the first few hours. Then, already the next day, it crashed by 60%. Such swings are a nightmare for a passive liquidity provider, and the impermanent loss with a 60% price movement is enormous. The reasons for the volatility are low market capitalization, speculation at launch, and possibly profit-taking by farming participants. Demand for Switch also depends on faith in PocketFi. If TON users don't really use the Solana bridge, they don't particularly need the token. The audience may be limited to insiders. Liquidity. High yields have attracted decent liquidity. Otherwise, the yield wouldn't have stayed at 600% with a pool of $21,000. For example, if the APR is 600% and the rewards are $21,000 over 3 weeks, then the average TVL should be around $60,000. It's possible that the TVL was higher and the APR was calculated based on the 24-hour volume. But the scale of tens of thousands is still small. This means the price can be easily moved even by small sales. Reliability of the project and the PocketFi token. It's a new project. Although the idea is useful a bridge between the top-loan Solana and TON, but there are no guarantees that the project will take off. Competition among bridges is intense. The Solana ecosystem might not be interested in TON, and vice versa. If, after a couple of months, it turns out that the volumes going through PocketFi are tiny, the Switch token will lose its value and drop even further. It doesn't have any built-in value like a stable buyback price or a large community. The risk of a price collapse is very high. We've already seen minus 60%. After farming ends, another blow is possible. Farmers will receive rewards in stone and may decide to sell them. Plus, they might sell the Switch tokens they got back, if they had any. The selling pressure could push the price down. On the other hand, if PocketFi launches new features or TON announces support for Solana dApps, Switch could get a second wind. But overall, for a conservative profile, this asset is a speculative meme of a speculative bridge, pardon the pun. Its holders are mostly farmers, not long-term investors at this stage. Conclusion: market risks are extremely high. There is a potential loss of most of the value of LP assets due to a drop in Switch, or, theoretically, missing out on profits if Switch suddenly skyrockets. But for a farmer, that's less of a concern. They'll benefit either way. Their main risk is impermanent loss. In conditions of extreme Switch volatility, their impermanent loss can reach extreme levels. When the token price changes by several times, the farmer loses a significant portion of value, unlike simply holding the stronger asset. Specifically, a 60% drop in Switch, as has happened, leads to a loss of 20% of the initial deposit. And that's in addition to your deposit already losing 60% of its value. In other words, instead of 40% of the original value, you end up with 32%. Now, the opposite situation. If Switch had increased by 150%, you would have made a profit, but it would be about 8% less than if you had simply held Switch. Thus, IL hits the liquidity provider hard in case of a drop and slightly reduces profits in case of growth. With extremely high APR, participants usually expect that the reward distribution will compensate for IL. For example, in 3 weeks of farming, you can earn a 50% bonus. If the token drops by 60% and IL is 20%, the portfolio loses a total of 80%, but the 50% reward partially offsets these losses. Although it's still a significant loss minus 30%, if the token rises by 50%, IL is about 5%, the farmer misses out a bit, but the 50% rewards are added. So that's a total of plus 95% instead of plus 50% for the period. Everything is great. So the farmer is satisfied as long as there isn't a crash. However, as we can see, SWCH dropped significantly and IL noticeably worsened the situation there. An additional risk of IL is low liquidity. If one of the major LPs wants to exit abruptly, for example, after a lockup, it will cause a sharp price change while withdrawing liquidity, which can also lead to IL for the others. But considering that everything unlocks at the same time, it's more likely that there will be a collective market movement. To sum up, IL is a critical factor in this pool. It can be attempted to hedge it. In the end, farmers probably entered with the awareness that IL would be high, but with the hope that the rewards would outweigh it. For a conservative investor, such IL is unacceptable without active management. The possibility and conditions for withdrawing profits. The tone switch farming had special conditions. First, there was a 30-day lockup. A participant who staked LP tokens could not withdraw them until the end of the period on June 19th. Thus, during the period of extremely high APR, it was impossible to take profits or exit, even if the price fluctuated significantly. This increased the risk, but prevented the instant selling of rewards. Withdrawing profits monthly during the program period was impossible. You had to wait until the end. After 30 days, farmers can unstake their LP and immediately remove liquidity, locking in all the rewards they have earned. As for the rewards themselves, 10,000 tanthe were likely distributed either upon completion or during the process. If they were distributed gradually, they could be claimed. Let's assume the rewards were accrued linearly and became available on June 19th. In that case, the farmer could claim them right away. The Stone token is the native token of the StoneFi exchange. It is not widely traded yet. There is a mention that Stone is traded on D-Dust at a price of $1.85. The liquidity of the Stone token may also be limited. If all switch farmers receive Stone and sell it, the price of Stone will drop. This is a separate risk. When withdrawing your profit, you may find that your price has depreciated. But if you hold Stone long-term, you become a holder of the ecosystem. It's a matter of strategy. After the lockup period ends, you can withdraw your share of liquidity either partially or completely from the pool. If you believe in Switch, you can keep your liquidity in, but without additional rewards, or with much smaller ones if they extend them. If you're only interested in profit, it's better to exit right away before the price ratios shift even further. Withdrawal at the end of the period and active management. In fact, this pool can't be considered for monthly profit withdrawals in the usual sense, because the profit was concentrated in a short period and required waiting until the end. After that, if you decide to stay, you do so at your own risk and can only count on the commissions. In that case, of course, you can withdraw the commissions monthly, but they will be negligible. It's more appropriate to say that such pools are for sprints. Enter for 2 to 4 weeks, collect the reward, and exit. Active management here meant exiting promptly after farming. In the first hours after the lockup ends, the switch rate may fluctuate sharply. Some people will start buying or selling. A successful farmer is the one who manages their position correctly at that moment. Conclusion: this strategy is not for those who want to lazily withdraw interest every month. It requires careful monitoring, quick reactions, and readiness for restrictions. Long-term yield sustainability. The current 671% APR is absolutely unsustainable and temporary. It lasted while the campaign distributing 10,000 Stone was running just under a month. After it ends, the lion's share of the APR will disappear. Will any farming remain? Perhaps Pocket DeFi or Stone will decide to extend it under different conditions, for example, by distributing more Switch or Stone. But usually, such high APRs are just a lure at the start of a listing. After that, the APR drops to levels that reflect real activity. The realistic long-term APR for Switch Ton could drop to double digits or even single-digit percentage yields. After all, if the token is no longer the news of the day, trading volumes will decrease, and commissions won't bring in much. Without incentives, few people will keep liquidity there except perhaps the project's own enthusiasts or PocketFi's market makers to support the market. This means liquidity could drop significantly. Some will leave after farming, and the remaining liquidity will face a larger spread and may potentially profit from speculative price movements, but will also be exposed to greater price risks. So how long can high yields last? Only as long as the project is willing to spend its budget. 10,000 stone is a one-time thing? There may be other promotions to follow. For example, PocketFi might launch a new campaign later on, especially if new features are introduced that attract users. But expecting a constant 600% annual yield for months or years is unrealistic. Such generous programs don't last forever. Assessing the project's sustainability. If PocketFi is successful, the switch could start to grow and stabilize in price over time. In that case, the LPs who remain after the hype might profit from the token's price increase. But that's speculative profit, not farming. In the long run, farming yields should align with the level of risk. And the risk here is very high. Therefore, the expected compensating yield will remain high only if the market believes the risk is justified. As a rule, over time, the risk either materializes, the token drops, and farming collapses, or it decreases, the token survives, and things stabilize. At that point, the required APR also goes down because the risk is lower. Conclusion: ultra-high APRs are a race for short-term gains. Keeping your money in such pools for a long time is risky and pointless after the campaign's end. A conservative investor is better off avoiding them, while an experienced one should use them as intended. Get the tokens and exit. On that note, we'll wrap up this episode. Too much information doesn't do your health any good. So it's better to go for a walk, eat some fruit or seafood, and get your daily dose of physical activity. Call your loved ones and ask how they're feeling and how they're doing. They are worth more than all the money in the world. Remember that. Wishing you a great mood, and see you next time.